Futures are blood red, oil just ripped past $100, and BlackRock, yeah, that BlackRock, just told investors they cannot have their money back. If you own stocks right now, the next 10 minutes might save you from making a very expensive mistake this week. Look, if you're short on time and you refuse to listen to some random cat on the internet, here is the single most important thing I need you to walk away with today. There are two real shocks moving this market right now, Iran and private credit stress. But only one of them looks like a genuine structural threat, and it is probably not the one your feed is screaming about. Stick around and I will show you exactly why with the data. And hey, I am DataCat. If you are new here, quick background on me. I spent years as an analyst inside a Fortune 50 company. And at some point, I realized I was mass-producing slide decks that like 5 people read, who are basically my team's data scientists. And then you know what? Then the next thing I know, here we are. The channel is about 7 months old, still tiny. I am not going to pretend otherwise. I am not here to sell you a course or a Discord or some magic indicator. I just like digging into data and explaining what I actually see, not what gets the most clicks. So if that sounds useful to you, a like and a subscribe genuinely helps the channel grow. That's the only ask. And enough with that, let us get into it. So, you wake up this Monday, you read the news or just swiping on social media and you see that everything is deep red. All major index futures are heavily down after Friday's pullback. And then you see Brent crude has spiked north of $100 a barrel. Now your timeline is going to be full of people screaming about World War III, about a market crash, about how you need to sell everything and buy canned tuna. And look, I get it. When you see red across the board and oil doing that, the instinct is to panic. But here is what I want to do today. I want to separate the actual signal from the noise, because there is real signal in this tape. There is also a lot of noise. And if you mix them up, you are going to make decisions you regret. So 2 stories. Let's take them one at a time. Alright, story number 1. Iran. So here is what happened. Mojtaba Khamenei has been chosen as the new supreme leader. He is widely described as an aggressive, hawkish figure. And so the market looked at that headline and immediately priced in. This war is going to escalate, this is going to drag on, oil's going to stay elevated, maybe go higher. And on the surface, that logic makes sense, right? More hawkish leader, more war, more disruption. Simple. And this is something most people are skipping right past. A more aggressive political leadership does not automatically mean higher sustainable war capacity. Those are 2 different things. Intent is not the same as capability. So let me ask a really simple question that almost nobody in your feed is asking. Does Iran actually have the resources to sustain this war at the pace it started? And based on the reporting that is currently available, the answer appears to be probably not. At least not at the same tempo. Here is what I mean. The Institute for the Study of War reported on March 6th that Iranian ballistic missile attacks had declined by roughly 90% since the strikes began. 90%. The next day, March 7th, they reported that Israel estimates Iran has about 120 missile launchers remaining, which lines up with an earlier ID estimate of roughly 100 to 200 remaining. And Reuters is separately reporting that the Israeli and US campaign has been hitting underground missile infrastructure directly, which is consistent with that sharp fall in launch. Now let me be very clear about what this does and does not mean, and I need you to listen carefully before we move on. What it does not mean is that Iran is no longer a threat. That would be a dangerous conclusion. Even with degraded direct strike capacity, Iran can still affect markets through threats around the Strait of Hormuz, through proxy and militia actions, through drone attacks, through energy infrastructure sabotage, and honestly just through the psychological risk premium alone. Markets do not need Iran to win militarily. They just need Iran to keep making oil transport feel uncertain. And Iran can absolutely still do that. But what the data does suggest is that the specific thesis of that Iran is going to keep ramping direct missile salvos for months at the same intensity. That thesis is not well supported by the operational numbers we are seeing. Launch accounts appear sharply reduced. Launch cadence has reportedly collapsed. Missile production facilities and logistics nodes are being struck repeatedly. And on top of all that, Iran's own oil refining and storage sites are now getting hit, which worsens internal economic strain. So the headline narrative of hardline successor equals endless expanding war, it captures the political willingness to escalate, sure, but it may be overstating Iran's actual military endurance. Think of it this way. You know how a cat will puff up to twice its size when it's threatened? Very intimidating. But underneath all that fur, it is still the same 7-pound animal. Intent can look enormous. Capability is what actually determines the outcome. So for your portfolio, what does this mean practically? Like I said in previous videos, In near term, the situation in Strait of Hormuz is still problematic. Oil spike, inflation repricing, growth scare, de-risking in cyclicals, airlines, consumer discretionary, rate-sensitive names. That is all legitimate and happening right now. But as a medium-term thesis, the idea that this becomes kind of long, open-ended direct war supercycle, the available data just does not support that well. Not yet anyway. Okay, story number 2, and honestly, this is the one I think deserves more of your attention, even though it is getting less of the headlines. So here is what happened. BlackRock has a $26 billion fund called the HPS Corporate Lending Fund. This is a private credit vehicle. Reuters and Bloomberg both reported that this fund limited investor withdrawals after redemption requests exceeded the fund's quarterly cap. Investors requested about 9.3% of net asset value in redemptions, but the fund's standard quarterly limit is 5%. So the fund gated. It told investors, you cannot all leave at once. Now, I need to be precise here because the internet is already running wild with this. This does not mean BlackRock has a cash flow problem the way a bank run would imply across the entire firm. That is not what is happening. What it does mean is something more specific and still very important. The private credit structure is being stress tested in real time. Here is the core issue, and I want you to really understand this because most coverage glosses over it. Private credit funds hold illiquid loans. Loans to companies that you cannot just sell on an exchange in 5 minutes. But those funds are funded by investors who expect periodic liquidity, meaning they expect to be able to pull their money out on some schedule. In calm markets, that mismatch is manageable. The fund has enough cash flow, enough buffer, it works fine. It becomes dangerous when a few things start happening together. When investors start doubting the net asset value marks, when redemptions accelerate, when secondary market bids weaken, when the gap between what the fund says its assets are worth and what someone would actually pay for them starts to widen. That is when you get a self-reinforcing cycle. And the media is calling this a show me the money moment for private credit, which honestly is a pretty accurate description. Now, why should you, as someone who maybe owns index funds or individual stocks, care about a private credit fund? Because private credit is not some tiny niche corner of finance anymore. It has grown enormously. And if stress spreads beyond one fund, it can hit equities through several channels. Tighter financing for leveraged companies, refinancing stress for middle market borrowers, wider credit spreads, lower M&A activity, lower leveraged buyout activity, and potentially contagion into banks or insurers if their exposures turn out to be larger than expected. Is it an immediate systemic crash? Based on current public reporting, again, no, not yet. The fund is using its existing guardrails. There is no strong evidence of broad forced liquidations across the whole private credit ecosystem. There is no evidence this has turned into a generalized funding freeze. But, and this is the part I really want you to watch, here is what would make this much worse. If you start seeing more funds imposing redemption limits, sharp spread widening in leveraged credit, rising defaults in software or healthcare or sponsor-backed borrowers, pressure at insurers or business development companies or listed alternative managers, or banks tightening warehouse and funding lines. If those things start showing up together, then the private credit story goes from one fund gated to a real equity market threat. That is the escalation path you want to monitor. So if Iran is the cat puffing up its fur, the private credit situation is more like a cat quietly knocking things off the counter one by one. It does not look dramatic, but eventually something expensive hits the floor. Quick note on one more story that is floating around. Basically, it's reported that Oracle and OpenAI ended plans to expand their Texas data center site. This might raise further concern on the private credit stress on social media. But the existing core build continues, and the extra capacity appears to be getting redirected rather than outright cancelled. I'm not going to spend a ton of time on this because I do not think it is the primary driver right now. But it matters at the margin because markets had been priced for AI capital expenditure only going in one direction, up. Any sign of pause or financing friction can hit semis, power and utility plays, cooling and infrastructure names, data center financing narratives, and software names exposed to AI monetization expectations. This is not proof that the AI build-out is collapsing, but it is a warning that the assumption of infinite AI capex is getting challenged. And for the most crowded AI infrastructure trades, that repricing matters. So putting all three together, here is how I would frame it. Near term, Iran and the oil shock is the bigger driver of what you're seeing in futures this morning. Medium term, private credit is the bigger structural risk. That is the one with the potential to actually change the market's plumbing. The AI and data center story is an amplifier, not a primary driver. It confirms that capex assumptions are being questioned, but it's not a standalone cause of a market crash. Alright, real quick on levels, because I know some of you are staring at QQQ right now trying to figure out what to do. It's basically similar to last week's playbook. A bit of a recap here. Immediate pivot zone, 598 to 604 on QQQ. This is the live battlefield. Above it and holding, the market can stabilize. Inside it, expect chop and indecision. Losing it cleanly, downside pressure grows. Repair checkpoint, 607. This is the most important near-term tell. Reclaiming 607 is constructive. Holding it on a pullback is even more important than just tagging it. Recent swing high zone, around 612. If QQQ returns there and fails again, you start getting double top lower high concerns. If it reclaims and holds above it, then Friday was just a shakeout. My base case right now is that we are in what I have been calling Path B, the chop path. The market got its relief rally, but Friday's reversal says the tape has not completed its structural repair. Both bulls and bears still have arguments here, and that means range-bound, messy, frustrating price action until one side wins decisively. So look, I know Monday mornings like this feel awful. Red everywhere, scary headlines, the urge to do something, but the data is telling a more nuanced story than your feed is. This might be more than short-term noise, but not yet a decisive structural break. That's where we are. Now, one more thing before I let you go. If you are someone who remains open-minded and even cautiously optimistic through sell-offs like this, pay attention to the VIX. It is already sitting at a 6-month high, and depending on how this week plays out, it could be approaching its 1-year high. Historically, when fear gets that stretched, it tends to mean the market has already priced in a lot of the pain. Not financial advice, obviously. I am a cat on the internet. But if you have been waiting for a buying window, this week definitely deserves your full attention. Keep the VIX on your screen. If this helped you think more clearly about what is actually happening, a like and subscribe is genuinely appreciated. 7 months in, still a small channel, still just a cat with a keyboard trying to make sense of markets. Alright, DataCat out, and I will see you in the next one. Take care of yourself this week.